Today, we're going to break down two essential tools used in business acquisitions: basic financial verification and quality of earnings, or Q of E. Whether you're buying a small coffee shop or a large tech company, understanding when to use each of these can save you a lot of time and money. Let's dive into it. Hi, my name's Trent Lee. I've sold over 600 businesses, and for the last 5 years in a row, I've been named the #1 business broker in the country for the most closed transactions, and I do that every single year for 5 years in a row. I make these videos so that one day, whether you're looking at buying or selling a business, you'll reach out to me and have me help you through the process. First, let's talk about basic financial verification. This method is perfect for smaller, straightforward businesses. Imagine you're buying a local retail shop or a small service provider like a landscaping business, just as an example. Here, the financials are usually quite simple and straightforward. The business model is easy to understand, and the transaction sizes are not very large. In this case, basic financial verification is your go-to, as it gives you the most necessary financial insight without the extra cost. You should be able to easily verify all of the income between their bank statements, their POS, their merchant processing system, and their tax returns. The three of those should be able to combine and easily show you at least the top line revenue. Now, moving on, basic financial verification also works well for micro businesses. These are small companies where deals are typically under $500,000 in size, maybe even up to $1 million. It's just not cost effective to go for something much more expensive like a Q of E, quality of earnings, for such small transactions. Also, if you're familiar with the industry or the specific business, there's a low risk, and it makes it easier for you to validate using basic financial metric verification rather than a quality of earnings. So in this case, sticking to the basic business verification can often be enough. But whatever you do, make sure you don't do it alone. Hire a competent third-party due diligence CPA that can do the basic verification for you. Now, let's switch gears to quality of earnings, or Q of E. This is a more detailed and crucial for more expensive, complex organizations. Say you're considering buying a construction or a manufacturing company where the money is made and recorded can get pretty complicated. A Q of E can help you understand the real earnings and ensure there's no surprises after you buy the business. Quality of earnings becomes vital for larger deals. Think about buying a company with multiple business lines or one that's spread across various regions. Here, the stakes and the complexities are higher. If you're stepping into a high-risk sector like technology, healthcare, something like that, where things change rapidly, Q of E provides a deeper look into the company's ability to adapt and grow through the cycles. And if you're a first-time buyer or the first time you're buying a business in a particular industry, and that purchase price is north of $750,000, a quality of earnings report is going to be vital to make sure that you're buying something that aligns with your goals and the desire of what you're looking to accomplish. Choosing between basic financial verification and the quality of earnings depends on size, complexity, and the risk of the transaction, as well as your experience in that industry. For smaller, simpler deals, basic financial verification might be sufficient, but for larger, more complex, higher price transaction, investing in a Q of E is usually the right choice. Remember, the right financial analysis not only saves you money, but it steers you towards making a well-informed decision. That way, the business you buy performs exactly the way you want it to, because there's no surprises post-transaction that you didn't already discover in the due diligence period. Thanks. Take care.